Welcome to Darren Batchelder's Real Estate Investing Show. Each week, you will learn how to grow your wealth through real estate investing. Be introduced to the players that are getting it done and learn how you can get involved. And now, here's your host, Darren Batchelder.
Hello, everyone. Today we have a very special guest. We've got Ryan McKenna with us. Ryan, appreciate you coming on the show.
Hey, happy to be here, Darren. Thanks for having me on.
Absolutely. So just a little bit about how we know each other. So this is actually the first time that we're going to be speaking. I'm very interested in the conversation. Ryan has been in the space. He's very experienced in the space, and I see him all over social media. So interested to hear his take on the industry. With that, how many properties and how many units are you currently invested in?
So as a general partner, we're over 15,000 units. And
over 15,000?
15,000 units,
Holy
yes.
cow.
And that's roughly 65 syndicated properties. And as a limited partner, that number is even higher. I've invested in all of our deals that we're a general partnership on, and that number is over 100 as a limited partner. So I truly enjoy passive investing. It's something that's changed my life, and I invest in a lot of different things. And value-add multifamily is really kind of the main driver in most of my portfolio as a general partner and as a limited partner. But I love this space, and there's so many great opportunities out there. So we keep growing, even though we had a really phenomenal 2021, and we sold off 14 properties, and so it was a great year. But we keep adding more.
That's fantastic. That's fantastic. So I saw from your bio, and I see it in the background, 3 bats. You played ball at Arizona State. Is that correct?
I did. Yes, that's correct.
Fantastic. So baseball player. My son was a baseball player through high school, but going college ball is tough. It's competitive, man.
It was. I mean, it was a dream to play at Arizona State. It was something I remember when I was 12 years old. I wrote my goals down on a piece of paper, and that was one of them, to play and get a scholarship to Arizona State. And at the time, that was the school. They've produced more Major League Baseball players than any other Division I school, and I wanted to play with the best, and never thought a kid from Elgin, Illinois would get the opportunity, but I did, and it was just an amazing experience. And it's really kind of a lot what I've learned going through the program, just the discipline, the determination, the work ethic. I mean, all that is what I've taken into the business world, and it's really helped me thrive. So great experience there, and it didn't end the way I would have wanted it to. I ended up getting really sick end of my sophomore year. Got diagnosed with ITP, which is a blood platelet disorder, very similar to like leukemia or lupus, and it pretty much ruined my baseball career. I was out for a year, did a medical red shirt. Doctors told me you'll never play baseball again, and this was probably the most devastating news I've ever had to take in my life, because I'd worked ever since I was 12 to get to Arizona State University and be on a platform where the next level is professional baseball. And I played with 16 of my teammates that went on to play in the major leagues, and not to say that I would have made it, but it would have been nice to go out trying versus having to literally walk away. And after I was diagnosed, I did a medical red shirt and had a very risky surgery. I was able to rehab for a year and come back, finish up my senior season, but I had to walk away on my own terms at that point, just because we didn't know health-wise how this happened, why it happened, and we just felt like at the time my health was more important than trying to chase a dream, and so I had to literally give it up. But it was in those moments where I was sitting in a hospital bed, I was like, all right, what am I going to do with my life? Because I always wanted to be that athlete that, was successful, did well, made, good money, but then was smart about it and invested, in various things. And so that's really where I got turned on to investing in syndications and the Rich Dad Poor Dad book by Robert Kiyosaki. I recall reading that while I'm bedridden and in the hospital, and things just kind of fell into place. It's like, all right, this was like my backup plan, but now it's going to end up being my plan A for me. And so, I was able to come back and finish up, the last, season on the field, which, was in and of itself, for me, nice
Huge
victory to kind of finish up. Yeah. I mean, with the doctor saying you won't ever play again, and just what it took to get back on the field. So I kind of look at like, my reference to baseball in this whole syndication business, being a passive investor. You can make pro athlete money doing this, and it's something that's not the driving force, but it was something I felt like it really has some similarities to what I wanted to accomplish in life, the lifestyle I wanted to live, and so it's been kind of a driving force for me to really take control of something that I had an experience that was out of my control, and it was a tough hand. I like to say life threw me a curveball, and you react to adversity. Some will kind of get knocked down and not get up, and I just said, hey, we'll keep moving forward.
That's
God
fantastic.
has a different plan for me.
Right. That's fantastic. So a few things there. One, so the listeners are mainly either passive investors or syndicators looking to scale. And, for the listeners' benefit, you said something that, may be glossed over, but as a 12-year-old, you wrote down your goal, and that imprinted in your head, and it drove you, from the age of 12 to get to where you were actually playing ball at Arizona State. And so for the listeners' benefit, I would say, look, you need to write down your goals. You need to believe that you can achieve them, and then have that be the driving force. There's a lot of people that want to get into this industry, into multifamily, but they're scared, or they get, they analyze things to death and they just can't pull the trigger. So you, while you're bedridden, look to, take your plan B and turn it into your plan A. How did you, so did you go right from baseball to multifamily, or did you have a career step between?
I had a career step in between, but I also had the benefit. One of my teammates, his father was an apartment syndicator, and they were buying properties in Phoenix. At the time, I was doing my medical red shirt, so I got to become pretty close with him and see what he was doing, and I got to learn the business. So I knew about the syndication business, the apartment syndication business back in the early 2000s, and I knew how lucrative it was. I saw it happen, with a lot of successful entrepreneurs where they were able to acquire these portfolios. And so all the benefits that, why we invest in it today, the cash flow, the equity upside, the great tax benefits. But the one thing that I thought was, really important too was, just the ability to control your time and to have, what you do, be more of a lifestyle. And that's really what I saw in this, in my teammate's father. He had a very successful syndication business, still has it today. And he's been able to, coach his sons in different, sports growing up. He's been able to be, have a flexible schedule, but he's also done very, very well, financially, and is doing something that, I told myself, like, that's the business for me. That's something I want to get into because I'm super passionate about real estate investing, and the syndication was just, it had everything that I kind of ever wanted in a business model, and it's fun, and I work with great people. So the combination of kind of having someone who was like a mentor who would actually send me books, we would talk about kind of the various deals. I knew at some point that that's where, I ended up wanting to get to, and I had a couple different, careers in between. I had a really nice offer when I graduated to go work for, at the time it was a serial entrepreneur kind of trying to launch the next Facebook. And so it was a great experience. And I learned a lot about growing and scaling businesses there. And then I got into our family's I was third generation, working with my dad for about 5 years. And so, I had always was kind of, doing the side hustle, trying to kind of get ahead and invest. And so I started investing in real estate back in 2006, and it was mainly our single family, I should say, with the goal of trying to, scale it into multifamily. But as, one of my side businesses did really well, I had enough money to start kind of deploying into multifamily syndications. And in a period of about 3 years, I was able to, I like to say, invest my way out of the corporate world and then launch McKenna Capital to really help others do the same. And so I kind of took the route of being a passive investor in syndications and creating enough cash flow or passive income to give myself that freedom and flexibility.
That's huge. There's more and more syndicators out there today, and there's more and more education platforms, whether it be podcasts or blogs or books or YouTube videos to teach you how to do it. But look, I'm 51 and I didn't get involved until 4 years ago, and I didn't understand even syndication, what it was and how to do it, and it was scary. And even though I had the capital, but I think it's it takes just one person. So you were fortunate that you met from one of your teammates. His father was a syndicator, and from the father's perspective, not a lot of next generation people are interested. There are probably a lot of teammates that were just interested in baseball and chasing girls and didn't take the time to try to pull out the wisdom out of him. So, I applaud you for doing that, because that kind of propelled you forward, So talk about being afraid. What was it like doing your first passive deal and your first syndication deal?
When I did my first one, I would say, it was a little nerve-wracking, because you're like, all right, I'm going to tie up this money for, a period of years.
Right.
But I think when I got to my first deal, I was actually more excited than afraid, because I had done a ton of research. I had read probably every book out there on real estate investing and growing your wealth through real estate syndications. And I felt like I was ready, and it was more or less just having some money to get started, because as I was building another business, I had a lot of capital tied up. But then when I exited, I had enough to really just deploy, and I knew right away what I was going to do. And I actually went and invested. My first 5 deals were with my teammate's father in his syndication business. So awesome. I got really good exposure. I knew kind of who to go to and how I was going to invest. And then from there, I started investing with other syndicators, because I knew how important diversification was, and I wanted to invest in different markets. Plus, I also knew that eventually I wanted to get into the syndication business, so I kind of wanted to see how others were running their business and the type of deals they were putting together. And I think it's a great way to learn for anyone who wants to get into this. Being a passive investor, you get to see how others are doing it and how these deals work, and you get to diversify into some great investment opportunities. So, being actively involved today, I still love passively investing. I think it's kind of, it's a very therapeutic type of investing, because, you get kind of the same benefits, but you don't have a lot of the headaches that most people will say real estate can bring them. And so, it's something I think I'll do for the rest of my life, because it's just kind of, it's fun to see it grow and accumulate. And then you start to get the snowball effect after several years of investing. And it's just kind of cool to build it and also build it with others, because I look at this as like a team sport with syndication. We're all in this together. We're all, working towards achieving the same goals. We're all on the same team. And so it's just a fun business.
That's a crazy part, what you just said. I mean, I've been part of a number of different industries. And when I heard this about team sport and people working together and, experienced guys helping the new guys, I was a little skeptical, like, is this for real? Like, typically the guys that are on top don't want to share their secrets with, that's my experience in other industries, at least. But here, there's so much partnering that goes on that, I've found it to be a reality that 99.9% of the people that I've met, are really genuine and want to help the next guy. And who knows, it's maybe not 3 months from now, but maybe 2 years from now or 3 years from now, you may end up partnering with that person. So, people don't like to burn bridges. They like to help one another, which is really, it makes the industry a really great place to work.
Yeah, I would totally agree, because I've been in other industries too. And there's just a different feeling about, just the syndication space in general, and people who you might say, oh, they're a competitor, but you come together and you start doing deals, or maybe you end up buying, a property from them, and there's that relationship that matters, and you just never know. You don't want to burn any bridges, and I think that's something just in life in general. If you could treat people well and always be respectful, and you never know when that call's going to come or that person's going to reach out, and if you have a good relationship, I think it's going to only be a helpful start.
Absolutely. The other thing that was when I got into it and I just started investing passively, and I want to get your take on this, is I kind of thought to myself, all right, well, the senior syndicators, the ones that have experience, the ones that have been around for a while, why do they even want my money? Like, they already have their investor database. They already have their network of people. So why would they even want to work with me? Now, I found that not to be the case, but maybe if you could expand on whether you had that similar experience, and why do senior syndicators want to work with new people?
I would say that they always want to bring in kind of new capital, because what I've seen is that you take, for example, someone who solely focuses in one market. Their investor base, after they probably do 3 or 4 deals in that market, those investors are going to likely want to diversify outside of that market. And if they're solely focused on one market and they don't have, something else to offer, you need fresh capital coming in, because that's what I see where people want to diversify. So I think it's good to maintain those relationships, because just as you bring in new capital, then all of a sudden, those earlier investors, maybe have had a little breather, they've been able to invest in some other deals, then they come back and invest again. And it's just this perpetual cycle that happens. So I think you always want to be open to growing your investor base, just because you never know, who you can count on from time to time. And I think the more you can attract, the better the position you're going to be in as a syndicator.
Yeah, those are great points. I would add to that, over the years, the per unit prices have gotten higher. So the deals have gotten, more expensive to buy. So you need more capital.
Yeah.
And another thing is that I've seen people come into these, learn about the syndication market, fall in love with it, pull a bunch of money out of the stock market, and then maybe they diversify into 5 or 10 different deals. And after like a year, they're tapped out. Like, uncle, like, I don't have any more capital, and I have to wait until the first deal turns, goes full cycle. And some of these deals go 3, 4, 5, 6 years. So that's another reason why syndicators are always looking for, new investors to add to the mix.
And they also are scaling up likely with properties. Maybe they start class C, then go B, then A, and those properties cost more, and there's more capital needed. And so that's another reason.
Yeah, absolutely. I had one senior syndicator that was on the show, and he said, look, we got to the point where we had so many people that wanted to invest. If I kept doing, C deals, then I'd be like closed out in a matter of, a couple hours. And so in order to satisfy the needs of his investor base, he started to go up to B's and A's, because the deals get more expensive, and so it requires more capital, and so he can get more people into the deal.
Yeah.
So talk about your first syndication deal. What was that like, going from, being a passive investor to moving into the syndication space?
It was a little nerve-wracking, because, you just don't know what to expect, and you hope that things kind of, work out the way that, you were anticipating. But I also am a believer that, you got to take action, and you're never going to have all the answers up front. You might know 90% of what you're getting into, but that 10% is, that's the gut feel that you got to, go with and trust that you're going to be able to make it happen. And so it was, the smaller deal, which again, most people start that way. And, but it was a confidence builder, was able to get one done. It was actually in the self-storage industry. And so, and I personally invested too. And at that time, I had been sharing enough with people in my network what I was doing, all the deals I was passively investing in, that it was mainly friends and family that I kind of went to, and they were ready. It wasn't just like, hey, overnight I got a deal. It was just, they'd heard me talking about what I was doing for months on end. And then, we started small with one and then just kind of build off of that. And I was, I was real happy to see it kind of work out even on a small scale. But then, each one got a little bit bigger, and I was constantly, sharing what I was doing with people in my network. And I just saw just a high level of interest. I knew there was something there. It was just a matter of just sticking to it and grinding it out, and also just trying to, partner with good people, good investors. And it just made the experience go that much better.
Absolutely. I love what you said, telling people what you do. Like, listeners, you need to do that. Tell people what you're doing, whether you're going to invest in your first passive deal or your fifth passive deal, or you're going to syndicate your first deal. If people know that you're learning and you're getting involved and you're having positive experiences, then they're more apt to want to invest with you and partner with you. So make sure you tell people what you're doing.
Yeah, I actually went and reached out. I put a list together of 250 people in my network from like LinkedIn, just coworkers, friends, family, and I reached out to all of them and said, hey, can we meet up for coffee or a quick call? I just want to share what I'm doing. And this was just a very simple outreach. And there was only about 5 of those people in my network who said, nay, I'm not interested in getting together, catching up. And so I had 245 people that I was able to share what I was doing with before I even had any sort of deal. And it was just like, hey, here's what I'm doing on the side passively. And the level of interest was extremely high. So that's kind of how I had a little network to start with of people when I did have some deals I could share with them. Yeah. And it was all based upon just tapping into people that I felt like, there was this kind of relationship with them that, and I would tell them, I said, hey, if you came across something that you really believe in, I hope you would reach out to me and tell me about it. Right, and that was kind of like the attitude I had. And it was never a sales pitch. It was just like, hey, here's an opportunity that I learned about that's impacting my life in a positive way. And I care enough about you that I want to just sit down and share what I'm doing. And that was the approach all along. And just, you could feel the energy in the room and people being like, yeah, keep me in the loop. Let me know what, share what you're working on and share that experience, with what you've got, in the pipeline. And so it started from that and it just continued to keep growing and growing over time.
That's huge. And I'm sure that, for you meeting with all those people, you learned a lot. You learned what are the questions that they have? What are their concerns? What are they investing in now? And, what's the leap for them to go from that to this? And so all of that is huge. The other thing you said was use the word opportunity. I think that's so key. Some people really get caught up in that, they want to get into the syndication space, but they're afraid of the capital raising side. And they look at it from the standpoint of, I need other people's money. Yeah. And it's not that. It's an opportunity that for you to help grow their capital.
Yeah.
And they don't have to do it. You just move on to the next guy.
Yeah. And it's most people, what I found when they learn about it, they can come to their own conclusion very quickly on, hey, this is a good fit for them or not. And I will say most realize they're like, yeah, this is better than what I'm currently doing. And then I would say about 90% of our investors have done multiple deals. So then it grows into a strategy of where they're like, yeah, there's not really a better place to put my capital when I can diversify it and do it in that manner. So it's one of those, I think, and then it just starts spreading because then, those investors want to share it with people, in their family or their coworkers. And it just, that network effect that organic growth is really cool to see because, people are sharing something that they believe in, that they put a lot of trust and faith into someone, and to see them go out of their way to continue to bring more investors into this. Because I think a big part of this whole industry is creating awareness I mean, I still believe 99% of the population out there doesn't even know what a real estate syndication is, nor do they know how to get access to one. And so I think there's a huge opportunity. And so it's kind of like my mission. I just want to spread the word because I don't care what someone invests in. I just want them to know that there's these other great opportunities outside of Wall Street that are available. And it's worth doing your homework, your due diligence to see if it's something that might be a good fit for you.
I completely agree. I completely agree. I think that, I mean, look, I didn't get involved until I was 47, and I was around wealthy people, and I never had anybody offer me an opportunity to get into a private syndication,
Yeah, I think it used to be kind of like, you had to know someone at the country club, do the secret handshake, and, oh, by the way, here's the deal. Whereas, just now with things going more online, I think it really opened up kind of the floodgates to really share more education around, these type of syndications, what they're all about. So I think there's still a huge opportunity there. But yeah, I mean, really in probably the last 5 or 10 years, I've just kind of seen it explode. And the number one comment I get from most investors is kind of just, you alluded to it a little bit, but it's like, hey, I wish I would have known about this 10 or 15 years ago, I could have grown my net worth to. And I always say, yeah, I knew about it, but I wish I had more money to invest back then.
Right. That's the flip side. It's like the young guys don't have the money. The people that are older, they didn't know about it. Right.
Yeah.
So, hey, how would you answer this question? I got this when I was doing my coffee meetings, and this is more geared towards the people that I met with that, there's some of the people that kind of knew multifamily and invest with a bunch of syndicators, and they know the business, and their questions are different than the ones that just are in your personal network. They're like, hey, I don't really understand this thing, but I know, like, and trust you. What's the biggest risk do you see in these real estate syndication deals?
I don't worry that much about an investor losing capital from the standpoint of, we're buying, value-added real estate that is already profitable from day one. The day we take it over, there's already a cash flow stream associated with it. We're going to go in and help enhance that, that revenue and through capital, expenditures, and help try to, optimize, some of the expenses. So I don't necessarily, I know it's possible. There's no guarantees. But I feel like the biggest risk to an investor, might be if, your capital's tied up. Like, you should only be investing something that you just, assume that you're not going to see anything for 5 years. And that's kind of the hurdle you have to get over and get comfortable with that. And if you are, then I think, the ride will be much smoother, knowing that, the likelihood of things working out, I think, are very high. So I think just around knowing what you're getting into, like, I think, there's a difference between someone who buys stock and when they want to, cash out or they need the money, they can sell it and get it in a few days. It's very liquid. And I think understanding that these are illiquid investments, and I think there's a lot of great attributes and reasons why the deals are better from that standpoint, because you don't have that emotional reaction of when the stock market goes up and down, like, oh, I got to cash out. It's like, real estate's more on a quarterly to quarterly basis, and I think you get rewarded for that staying power. So I think, also not doing, and you should do your homework with who you're investing with, because I tell investors, like, we look at so many deals and, the numbers all start to look the same from deal to deal. Just you kind of have the going, return, the going rate. I think the most important aspect of the deal, it's the people behind those numbers. And if you can get that part right and you invest with good people, surround yourself with good people, I think you're going to end up in the long run doing very well. So I think at the end of the day, like, that would probably be the biggest thing I would say. Like, if you can get that part right, you're going to be in a good place. There's going to be risks, there's going to be unknowns, but, like, you have to have, belief in that team that, like, when something comes up, that they're capable and competent, and they're going to be transparent about how they handle that, because not everything's going to go perfectly. And so I think knowing who you're investing with is huge. And for new investors, there's that trust, that comfort level, because they're essentially putting money, with you and in your company, and they're hoping that you're going to generate a nice return for them. And I think you just never want them to do something that they're uncomfortable with or that they feel forced. And so I think it's just kind of that approach, that type of psychology around just feeling comfortable with the team, and then also having a track record too. I think is important, so you can kind of show, here's what we did in the past. There's no guarantee that we're going to do this in the future, but at least they know it's not your first kind of rodeo, and you at least have a high likelihood of having success.
Those are all great points. I really agree with everything you said. I mean, I would start with, if a passive investor, I would start with the market, like what market do you want to be in? And then the second piece is who the people are you're going to invest in. And after the people, it's looking at the deal. Yeah. But people that aren't in the industry, it's difficult for some of them to really understand. To your point, I see a lot of deals too. And almost every deal has the same return, forecasted return profile. And the people is very important to me. So you brought up liquidity.
Relationship business. I mean, I think, that's people are going to make their decisions with what you said, people they know, like, and trust. And I think that's a huge portion of why someone would, decide to invest with you or not.
Absolutely. So have you lost on any of your deals?
No, I'll knock on wood here.
Fantastic.
We have not.
So,
I mean, we've had deals that have been behind.
I kind of put you on the spot because I didn't know the answer, but I had another guy who's invested like in over 40 passive deals, and I asked him that question. I said, "Have you lost on any of your deals?" And he said, "No, Darren, I haven't lost capital on any of my deals." He said, there's some deals where they project this cash flow, and I got less cash flow, or maybe I didn't get any cash flow until it sold, and then I got a gain. Or sometimes the business plan may have been 5 years, and there was a hiccup, and they had to hold it till 7 years. But then when they sold it, they still had a profit. And so, that's a fantastic, track record to have 40 some odd deals, and you're invested in over 100 as an LP, and not to lose your capital. So I think capital preservation is huge in these deals. One of the risks that I talk about to my people I'm close to is and it's because I have another business that trades loan portfolios between banks, and during the big recession, the Great Recession, whatever, 2008, 2010, where I saw people get hurt was when the loan came due in a terrible economy. So I'm sensitive to the term on these loans that are on the deals. You can't get a 30-year fixed rate mortgage on these big multifamily deals. So they all have some type of balloon feature, which just means that the loan comes due. And a lot of people are doing bridge loans today, and I get that they're very attractive. And as long as you can do the value add in the year or two, you're fine. But that's the piece that I'm a little bit conservative on is that I'm okay with like having a floater, and a cap, but I want to know that there's a longer term than 3 years. I want to know that there's a 5 or 7 or 10-year term, so that if I can pay the mortgage, the lender can't take the property from me. And that's where I saw people get hurt. And I wasn't involved in any of those deals, but I'm dealing with the banks that are, buying the loans, and that's where they came back and would tell me, like, hey, here's the problem, and is the property cash flow is down, and the loan's coming due, so the valuation is down, and the sponsors don't have the excess capital to bring into the deal at that, so they're not going to refinance it. So what's your take on that?
Yeah, so my take is it's always something to be thinking about and planning for, and to have flexibility on an exit, whether that's to sell in a certain period of time or to refinance. I think, I would agree that, all the deals that we do, we at least want to see 5 years, even if it is a bridge loan where we have 3 years and then 2 1-year extensions, because all the decisions we're making, I mean, we never want to back up to, the 5th year and be like, all right, what are we going to do? I mean, generally we're 2 to 3 years in, and we're making that decision of like, are we going to sell or are we going to refinance to some, long-term, fixed rate debt? And I am starting to see, I would say, most deals I'm still seeing are the, the bridge loans with some floating debt with a rate cap. But I am starting to see, talk of like, all right, finding a high quality asset and let's just lock in some, some low, rate agency debt. It's again, I think it all comes down to diversification. Like, you're probably not going to get as high a return as a value add deal, but like, there's more, it's more conservative. It's a longer term, then that you're talking about maybe that hold period is 7 years. And, you can still exit where you can, if you get a nice attractive rate, that someone can come in and assume that loan. So it's not a bad strategy. And I think, I think there's still a window. We don't know how long, things are going to continue to be as good as they are. But I think that, we're starting to see a little bit of like, all right, let's kind of look ahead, and maybe for some deals that makes sense. But yeah, we're generally, trying to put ourselves in a flexible position so we can make that decision well in advance and really kind of shift if we need to, if the market or environment changes. But yeah, the plan is, we want to obviously generate as high a return as we can, but we also know that there's going to become a day where, the value add multifamily, it's getting harder and harder to find, really solid deals, just because there's only so much value add out there. And with cap rate compression, they're getting more expensive. But I do see, a little shift towards, maybe some Class A, more stabilized asset, maybe try to lock in some long-term debt. Certainly in a few years, I think that'll be more the norm than the bridge debt we're seeing today.
Yeah, and I think that plays into the whole inflation story too. Now, if time will tell whether it's transitory or, whether it's, going to be here for a long time coming. But, if you buy a long-term asset like that, that has an A property that has, a lot less maintenance, and you lock in your debt, so your debt service stays constant. But then if there's inflation, that means, the wages are going to go up, and most likely rents are going to go up. And so your top line could continue to increase year over year, where your debt service, remains constant. So you can get that profitability increase as time goes on.
Yeah, no, it definitely. I think it's a balancing act of, trying to, for certain properties, but also, looking at the environment. Because we also, I would say, 3-4 years ago, we locked in some low rate agency debt, and we're now in a situation
yield
where
maintenance, you can't.
Yeah,
sell
we want to sell these fantastic assets, but we're going to pay a prepayment penalty of $1 million or $800,000, and it's like we didn't have that with the bridge debt, and we could exit those, and so you got to. You got to figure out what's the best scenario. We thought interest rates were very low a few years ago, and then they got even lower, and then now we're kind of seeing a little reversal. And so it's I think at the end of the day, just trying to be as flexible and diversified as you can, and you're trying to make the best decisions that you can for everyone too. And but everything's still as long as it's cash flowing and you're growing and doing well. I mean, we don't have to sell. We continue to just keep increasing ROI, and that day will come. It'll happen. It's just we wish we were able to do it earlier, but that's just the situation we're in.
Absolutely. So what's your advice to people that they're new and they want to be a syndicator, and how, it's extremely competitive to win a deal today. Yeah. So how do they do it as a newbie?
I would say, before someone wants to get into the industry, my advice is always like, I think it's helpful to become a passive investor first, at least kind of know what these deals are all about, because you can speak to your own experience when you're talking to investors about what your syndication is going to look and feel like. And you don't have to do that, but I just think it's only going to be beneficial. It helped me out tremendously. I agree. And I think that would be kind of probably step one. And then, figuring out like, okay, what market are you going to focus in on? Who's going to be part of your team? Because in this business, you need a team. And maybe it's starting off by trying to add value to someone who's already in the syndication business, and you might be able to join their team and help them out and gain more experience that you could then leverage down the road for other opportunities that you might be pursuing. So I think trying to surround yourself with people who are doing what you want to be doing is also key, and then trying to find a way to add value to them. And that would be kind of my advice for someone just getting started.
I think that's perfect. I mean, I don't think you can win a deal in today's market, at least in the large scale multifamily, unless you partner with somebody who has experience. There's too many people bidding on these deals, and the broker and the seller are not going to pick you if you're, a newbie and don't have any experience. But you could be a newbie partnered with an experienced guy, and that works. And
Absolutely.
The other thing I would say is that when we talked earlier about tell people what you do, I've had some people come to me and they're like, Darren, man, I just don't have the experience. Like, I want to talk to, my network, but I don't really know how to even, pitch them. And because I don't have the experience, how are they going to, give me $100,000 to invest in a deal? And I'm like, it's not about you, right? It's, who's the attorney you're going to be using? Are they, a specialist in syndications? Who's the property management company that's going to be managing the property day to day? If you bring on a property management company that's managing 10,000 units in that market, well, all of a sudden they're like, oh, it's not you answering the phone call. It's like, these guys know what they're doing, Who are the lenders you're going to be using? Well, they specialize in multifamily. So that's part of the team that Ryan's talking about.
Yeah,
and
absolutely.
You start selling the team, your partner, the attorneys, the lenders, the property management companies. And then all of a sudden, people are like, oh, this guy's got it buttoned down. He's got a team, So that's what he's referring to there. So here's something that I thought after getting my first syndication done. I'm like, okay, well, you get your first syndication done, and then it's just you kind of what you're doing, and you just truck on. But like all the people that I've met, not all, but a lot of the successful people that I've met are always pushing themselves to go do something that they haven't done before, that puts them in an uncomfortable position. So talk about, an area of your business, your growth, where you had to get uncomfortable.
Yeah, I would say, we're very comfortable with value-add multifamily. It's been our core focus since we started. But as our investor base has grown and is very diverse, and I'm in touch with a lot of our investors as far as what they're looking for, and we had a segment that was willing to take on a little bit more risk for some higher upside and wanted to explore other alternatives. So we started a few years ago getting into other asset classes beyond multifamily, to help kind of provide, more diversification in a portfolio. And, there was, an education around that just, for me personally. I did a lot of, my own due diligence. I did a lot of my own personal investments in these areas to try to kind of learn as much as I could. And then I tried to find, really good partners in the space, just like we do in multifamily, and then, try to find a way to kind of make it all, come together. And so, we've expanded into, we just did a senior living development deal. We've done, ATM funds, self-storage funds, mobile home park funds. I recently invested in a Bitcoin mining fund. We are looking at all different asset classes as a way to provide, great deal flow, good diversification. And a lot of the characteristics are very similar to multifamily, nice cash flowing deals that have some sort of value add or equity upside play and great tax benefits. And so that, it was uncomfortable when you're putting your neck and your reputation on the line for something that is new and different, and people know you as like having experience in the multifamily space. And so, it started again with one small deal, and then that was successful. And then we grew from there, and then we went into another asset class, and then another, different type of deal. And now we've just got some really unique, opportunities that our investors love, and they now pair them with multifamily. So as we see multifamily cash flow, going down a little bit, there's other deals out there that can provide a lot of cash flow. And so you, as an investor, if you're looking at your overall portfolio, you can kind of marry the two together, and that makes, a really solid deal where you got one with a lot of upside potential, maybe not much cash flow, but then you got this other one over here that's very conservative, but high cash flow. And a lot of investors we see making choices based upon, almost doing two investments into one. And it's just, it's an area that is something I see growing very rapidly, especially with inflation and just, great value add multifamily deals getting harder and harder to find. But there was, a feeling of like, all right, this is new. This is, right. Something we're exploring that is, we don't know it as well as multifamily, but we believe in who we're partnering with. We believe in these opportunities and these assets. And so it's all part of the journey, the experience. And the investors know we're in this together. I mean, we're trying to make the most calculated, educated decisions we can, and no one has a crystal ball. But I think, by being open-minded to what else is out there and listening to investors as far as like what they're looking for, that's really, why we do what we do. I mean, I really try to keep up with the demand, and also personally, I'm building out my portfolio, and I like to invest in a lot of different things. And so I think it's fun to really kind of explore and bring those new opportunities together, and then syndicate it with people who have an interest in investing in those types of assets as well.
I think that was extremely smart. I mean, you looked at, you actually got feedback from your investors. What are you looking for?
Yeah.
And they told you, like a segment of them told you, hey, look, we'd be interested in something a little different. And then you went out and explored and came back with something, hey, would this work, And so you already had the investors kind of lined up, and they're telling you, we want some more diversification. You talked about it earlier, diversification could be multifamily. Hey, I've got enough in Texas. I want to go to Arizona, and maybe you go with a different syndicator when you move, out of state. But there's also, hey, I've got enough multifamily. I want to try something else. And if you just do multifamily, they're going to go to somebody else. And so that I think that's very smart. Hey, question for you. How do you structure your deals, and how did you partner with these other asset classes? Because you said funds. So do you do funds, or do you do one-off syndicated deals for each one of your multifamily assets? And then when you invested and partnered with these other folks that had funds, how did you do that? Was McKenna Capital the investor in those deals, or how did that work?
So it's a little bit of everything.
Okay.
We do most of the multifamily. We do our single asset investments that we joint venture on, and I'm very involved. A lot of those deals, I'm the loan guarantor as well on them. We put up earnest money on every deal. As far as the funds go, that is a combination of a fund. Other times we've been the fund sponsor, the fund manager. It really depends on, we look at the deal overall and see how does it make sense? What's the best structure? Because, sometimes it makes sense to have a larger fund or to do a fund of a fund. And so we've been open to all, we've done all, and each one kind of has its own, purpose for setting it up that way. And certain deals that I find more of the alternatives outside of multifamily are more kind of in the fund structure. And so, we've gotten very comfortable with that, and it's been a great experience. And that's probably the one where we've had a tremendous amount of growth in kind of seeking those out, putting those deals together, and so it's cool because we can kind of leverage and what we see out in the space and the terms like we have a really interesting deal that we put together that's short term. It's 12 months and the cash flow is really high, and that's a nice opportunity for people that want to just park money somewhere and not have it tied up for 5 or 7 years because maybe they don't know what it's like, or maybe they've already done that with 10 or 15 multifamily deals. And so that's, again, listening to investors and trying to get creative and just through kind of our network of, what we, who we know and what we know in the space, we're constantly like I talk to other people in the space, from like an operator deal flow standpoint, multiple times a week. And so, we're always just building those relationships, even though we're not looking to. I mean, we've got a full plate, we've got plenty of deal flow and opportunities, but you just never know. There might be the one or two opportunities that you look at in the future that, like, enough investors are asking about it, and you're like, oh yeah, I know so and so. We were talking. Hey, maybe someday something might work out. It might make sense to partner on whatever it might be. And so that's something I take very seriously, because that's what I think is given our investors something that is very unique in the space, because we've been able to go across multiple asset classes, multiple geographies, and then also within those deals, you've got short term versus long term, high cash flow versus big upside, no cash flow, and just really being able to throw it all out there to the investor and let them choose what's most important to them based upon their needs and their goals and objectives. And so I think we've been able to hit pretty good approach with that, and it's only been because we've listened to what the investors have been telling us and what they're seeing. And a lot of these investors are very sophisticated. They look at a lot of different deals. A lot of them run companies or they're in venture funds, and so we try to kind of ask them questions when we're on the phone, because their businesses are very interesting too, and what they're seeing and how they're dealing with just certain economic events that may or may not be impacting or driving their business growth. And so I try to still be a sponge. I'm still learning every day, and I love to hear an entrepreneur their story. How did you build your business? Like, sure. I had two of those conversations yesterday with two investors that run companies, and it's like, well, how did you get started? Like, tell me about just what you're doing today and what your plans are for your business for the next 5 years. And it's just like, I get inspired by that, because I've always looked up to people who had, a bigger business or were more successful. And I just never looked at it as like, oh, I'm jealous or I'm trying to compete. It was just like, hey, I'm just trying to learn, and I'll make it work, whatever it looks like for me. I'll take the best of what I've learned and make it my own and feel good about that. And so I always kind of just taken that approach, and I think it's worked well, because the investors feel like, hey, you're listening, you're taking what they're saying into consideration, and you're out there trying to make things happen.
Well, that's the value that they're getting by working with you, right? Is that you're going out and learning and building those relationships, and then taking that and providing them with an opportunity, and they could either jump on that opportunity or not. But if you didn't do that, they may not have had access to that opportunity. It's funny though. I've talked to a lot of, syndicators that have thousands and thousands of units, and I've asked them about, hey, you've done, 10 syndications, whatever, like, why not start up a fund? And I get silence. Like, there's people, I think that, and it's funny because when I talk to them about being afraid of doing their first syndication, they're like, yeah, man, I was afraid doing my first syndication. Like, am I going to raise the capital? But then they get used to it, and they know the investors are trained, and they know that they have an investor base that is going to fund that deal. But going to a discretionary fund where they have to raise the capital before they present the deal, I sense that there's some fear that, oh, this is new. What if I come out with it and nobody wants to invest? Like, I'm already, have a great track record, so that's a risk. And I think that some syndicators are afraid to take that risk. But it sounds like you did it.
I did it. But there's also, a lot of upfront costs. And in a lot of these funds, we don't earn any money until the investors, make their returns. So, I'm outlaying a lot, $50,000, $75,000 to get this up and running. And then maybe a year later, I might see some, so like it's, there is risk, and so you have to really believe that it's going to work. But you also have to know, kind of going into it, like, hey, this is going to be worthwhile. It's not like I woke up one day and said, hey, I'm going to go start this fund. It's like, just again, we're kind of reading the investors and the industry and the opportunities that are out there. The first one was very tough. It was a lot of work because you're kind of on your own putting it all together, and you're doing it in a kind of a different way. And so I think you just have to be open. And again, it goes back to like, just trying to learn and taking risks. I like to say, calculated risks, and just really kind of believing and seeing it, all the way to the end. And so I think, yeah, you can do it both ways. I mean, I do like the direct investment still in multifamily because a lot of it, I think the value in when we exit deals with the 1031 exchanges, I mean, that I feel like a fund approach, you might lose some of that, but I know there's pros and cons to both. But a lot of the other alternatives, I see more and more of those in the fund structure, and it makes things, I think, a little bit easier, and there's a little bit more diversification for those types of investments.
Talk about the 1031 on the value add multifamily, because of all the syndicators I've talked to, I've only had one that said, actually I've had two that have said that they've done 1031 exchanges. One of them explained that it was extremely difficult because of all the paperwork associated with all the limited partners. The other one said that they do that exclusively. So there's a huge tax advantage to rolling it over, but it sounds like for most syndicators don't do 1031 exchanges. They, return the capital. Investor has their tax liability and then, roll it into a new deal at that point. So what's your take on that?
So our take is when we're exiting a deal, that's the number one thing we're looking to do is to try to 1031 exchange if the deal makes sense. I mean, there's a lot of times that you don't find a deal in the time frame that's needed, but that's number one. I mean, we want to, because we know the value in providing that to our investors. And plus, as a general partnership, most of our money is going to be made on the back end. We'd love a nice way to defer those taxes via 1031 exchange as well. But the beauty of it to an investor is that they get to choose. Do I want to participate in the 1031 exchange, or do I want to cash out and pay the capital gains taxes on it? So, we've had a high level of participation. About 70% of our investors have opted to do the 1031 exchanges. And I would say probably about 40% of our deals that we exit, we're doing 1031 exchanges on. And, so but it is a lot of paperwork. It's a lot of gauging investor interest early on, and then, kind of getting to the commitment. And in some cases, we know the deal that we're acquiring or going to 1031 exchange into. Other times we don't. And we just have to, say, hey, it's going to be similar to what we just, are rolling out of. And it's kind of one of those leap of faith, we don't have the details, but here's the plan. And sometimes we got to know the numbers by a certain date and have everyone kind of locked in. So yeah, it can be, a little stressful and you might not have everything all, aligned but it's just part of the process. And
that's a great number. So 70%, 70% typically choose to roll over into the 1031. And yeah. I think that, correct me if I'm wrong, you probably know this better than I do, you need at least 50%. Is that correct?
Yeah, it's usually 50% of the capital that, so you could have a couple big investors that opt for that. And yeah, you also want it to be meaningful too, because, again, there's a lot of costs involved, a lot of work involved. But on some deals, you can structure it where you can actually do the 1031 exchange and then, depending on if the deal's large enough, take in new investors in a separate LLC. So you kind of, get to, appease the 1031 investors with a great opportunity, and then you get to still bring it to your investor base as a new deal as well. And so we've done several of those where it's kind of a combination.
Fantastic. So is there anything that we haven't talked about that you want to make sure that the listeners know about, either your company, what the deals that you guys structure, the markets that you're in, or things that they should pay attention to and get involved in the industry?
I think we covered a lot.
Yeah, we did cover a lot. So I just want to give you an opportunity if there was anything.
One thing I will say is that we didn't really go into too much detail on this, but I've also, as an investor, I've been investing in the crypto space for a couple of years now, and I see more and more interest from just casual investors asking about it. I see a day where that is going to be, part of the syndication space, because that is digital real estate. I mean, there are passive income streams there. I invest in a lot, and I'm getting passive income no different than I do in a real estate, syndication. And it's very, very lucrative, but it's still kind of like the Wild West. It's not as mature as I would like to see it. but we are, exploring that space. And I do see a day where the two kind of come together and there will be syndications there. And for an investor, who just, again, it's all about education and learning at this point. But I do see that as a very attractive, alternative asset, area where a lot of money is going to be made, but there's a lot more risk right now. So I plant that seed as I think it's something as an investor to just at least know and understand, or at least start paying attention, because we definitely, I think, are going to have a run here that a lot of money is going to be made. There's going to be a lot of opportunity, and I think it will complement what we're doing in real estate and in that syndication space. So I'm very and I've been learning a ton, because it's a fairly new industry and asset class, and it's very fascinating too. But it's like kind of what I do on when I have free time. It's like I enjoy that type of stuff, and I enjoy again even further diversifying my portfolio. But I guess I just would mention that I've heard more and more people talking about it, and just it's something that I personally have been exploring, and we're definitely we want to be on the forefront of what's to come.
I appreciate that. I don't know that much about it. I'm curious about it and need to learn more about it. People are definitely making good money in it, and I've also heard we talked about liquidity in these syndication deals. I've also heard that down the road these syndications could be somehow tokenized, where you can actually sell out of your interest and using the crypto, where that is interesting as well, because then it takes away that kind of negative about, or it could be a positive, if it save you from selling at a bad time, but being able to create the liquidity.
That's a very important point, and that's something that we've already explored. It's still a little ways out, but imagine if your investors, had the ability to unlock some liquidity in all the, limited partnerships they're in. Because that's the one biggest thing I would say about being a limited partner is you can't really go to the bank because you don't own the whole asset, and you can't really borrow against it. You can't get a line of credit. But if you can tokenize it, for example, owning Bitcoin, it's something I invest in, and you can borrow up to 70% of the value of Bitcoin in a tax-free, loan to yourself for, a few percentage interest rate, and do it without a bank, and get that money instantly and go invest in real estate, more crypto. Obviously that's a high leverage point, but you could do 20%, 25%. But yeah, that day will come where you're going to be able to do that with real estate. And I think it's going to be pretty amazing for investors when that's available, but it's already available in the crypto space right now. And you can literally, leverage, not sell your asset, because, when you sell something, you're going to pay taxes on it, right? So imagine if you can, acquire some high quality assets. I would say I put Bitcoin there, and then never have to sell it, or sell it 10 years from now, but you can borrow against it all the way through. I mean, Fidelity just came out with this about 3 weeks ago. They're offering this to their institutional clients. I mean, it's becoming more and more mainstream, and that's what a lot of these early investors in Bitcoin who have made hundreds of millions or billions of dollars, they have not sold. They're just holding on to it, and they're reaping the benefits of the price appreciation, but they're borrowing against it to go buy, luxury homes, cars. I mean, and it's all tax free, and it's pretty amazing. So that's kind of it gets me excited, because that there's just, I think, more and more opportunity for investors out there, and so it's still very, very early though, and I think the combination of the two, you get your traditional real estate, and then you get the digital real estate. I think is going to be pretty fascinating, because I think they're going to come together and unlock so much potential and opportunities for many years to come.
Absolutely. So what's the next big stretch goal for you?
Oh man. I feel like I'm stretching every day. God, I have a lot of goals, but it's for me, we've been growing like crazy. We've been so busy. I mean, honestly, it'd be nice to be able to get a little bit more time back in my life. I've been running hard for many years, and but it's something I'm super passionate about. I absolutely love, but I definitely, on the top of the list, in the near future, it's a vacation home somewhere for my family and I. We would love to have a place to kind of go and get away, and so that's definitely going to happen at some point. But that's kind of something that we want to do, and we think it's important to have some family time and have a place where you can kind of unwind. But certainly, I want to keep expanding the business. We don't need to be the biggest. I just want to do high quality deals, keep up with the demand. But I think just doing what we set out to do from day one, just help as many people as we can in this industry and create more awareness around real estate syndications. I mean, it's very fulfilling when you can, see these deals go full cycle, and these investors, these people that you care about, like they put a lot of faith and trust, and to see, it come back to them, and they just get so excited, and they're very thankful. Like that to me is worth everything. And so
I agree. I think it's a way of serving. You're serving other people and helping them grow their wealth, and they all have different needs for that, whether it be retirement or whether it be college education or vacation home or whatever the case may be. So that's huge. Hey, what do you like to do outside of work?
So I love to be active. I like to ski. I like to golf. Play paddle tennis. It's kind of a winter league here, sport in the Chicagoland area. Obviously being a big baseball fan, I like attending baseball games, sporting events.
Awesome.
That keeps me active. Love the outdoors.
Fantastic. Skiing, Colorado, or where do you go skiing?
Yeah, Colorado. I love skiing out there. Grew up skiing in Colorado, just with family trips and vacations, and so Utah's nice area too. But primarily Colorado. We've got a few family resorts here in the Midwest that we'll take the kids to. That's a lot of fun. But there's nothing like Colorado, in my opinion, with having access to all the resorts and being able to ski at some great places.
Fantastic. Hey, Ryan, if somebody wants to reach out to you, what's the best way for them to do that?
They can just go to McKennaCapital.com. It's our website, and from there, that's usually the easiest way to contact me. We've got our investor club. If someone's interested in staying up to date with what we're doing, I try to post on all the different social sites, and so there's links and access to the various sites on our website.
Fantastic. Well, Ryan, I appreciate you coming on the show. Man, I can't believe you're a GP in over 15,000 units. Also, it's very cool that you've diversified into these other asset classes and have listened to your investors and let them expand with your company. So that's fantastic. Listeners, I hope that you enjoyed that one. Until next week, signing off.
Thank you, Darren.
Thanks, brother.
Thank you for watching Darren Batchelder's Real Estate Investing Show. If you liked the episode, please click the like button and subscribe to the show. If you already are subscribed, then thank you. And please share the show with a friend. Check out other free resources at darrenbatchelder.com/learn.